I'm Anat Admati from Stanford University, and I just spoke with a group of investors in a private meeting organized by Preventable Surprises. The system that we have right now is excessively fragile and dangerous and distorted and distorts the economy as well.
Hello, my name is James Featherby and I'm chairman of the Church of England Ethical Investment Advisory Group. It seems to me that banks have stepped way outside the normal principles of capitalism. Having a business that is 97% geared just could not survive in any other industry. Why do banks think they're different?
So my name is David Pitt-Watson and I am a fund manager, but right now I'm an executive fellow at the London Business School. Right now we've got a system where a bank will raise £1 of reserve money and then will feel free to borrow up to £30 that it can then lend out. So it's leveraged, it's geared 30 to 1. That creates a system that is potentially quite unstable.
They can make sure to ask banks to deliver actual value and not just returns. They need to make clear to regulators that their overall portfolios and the economy would benefit from a stable and healthier financial system.
People who run banks will tell you they run this for the shareholders, for the investors. So if the investors express a different view, then that would bring about some form of change. Investors are providing that equity money, the one, they're also providing an awful lot of the 30. One of the things they could think about saying would be to say, look, instead of you raise 1 from us, why don't you just borrow 10? So if you want to lend the same amount of money, take 3 from us in equity and then lend out the further 30. That would create a much, much more stable system.
One of the things I'd like to encourage all investors to think about is to think more broadly. So not only how safe or unsafe are banks, but what is the effect of the way in which banks operate on the rest of their holdings. And it's when you add those two things together that I think one gets a much more holistic picture and are therefore able to make more sensible decisions about what sort of banking system we want.
In terms of the numbers, people often challenge me to say, why do you have science behind these numbers? Well, these numbers are a little bit crude and they're just meant to say a lot more than what we have. And that's the analogy for that is, if you saw a truck driving down the road with explosive at 100 miles an hour, you would know that's dangerous. Therefore, having banks with 3 or 5% equity, I know that's something you don't see elsewhere, and there's a good reason for it elsewhere. Just because banks could get away with having so little equity doesn't make it good or useful or beneficial or essential or anything. So there's nothing good to recommend it. The levels of 20 to 30% are considered absolutely minimal in the rest of the economy. Banks themselves wouldn't lend to businesses that have less than that. And so just like with the trucks, you don't need to know whether necessarily the optimal speed is 35.7 miles an hour or 38.3 miles an hour. You know that 100 miles an hour is far from safe, and that reducing it to at least 60 is kind of a no-brainer. Well, if they don't want those risks, then you have to wonder about the business model of banks. If they cannot attract investors, then why is that?
When you think about who the investors are, they're not these great institutions, Fidelity and BlackRock and the rest of it. They're you and me. They're our pension fund, they're our life insurance. And since we have got jobs, since we are citizens, it's absolutely daft that our money is not invested in a way that thinks about the larger picture of what it is that we're trying to do to create prosperity in the economy.
Most healthy companies in the economy who invest and are thriving are funded primarily with equity. So the companies in Silicon Valley, where I come from, have primarily equity funding, and they invest and thrive and grow on equity funding, and they don't have that inherent conflict all the time about their investment decisions. They take risks. The risks are the upside of the risk goes to shareholders, the downside is borne by shareholders, and those are productive investments. So the public then needs to demand a better system.
I think investors have let the system grow partly because of a lack of what I would call holistic analysis. So we've tended to analyse problems by looking at individual pieces. So people have looked at banks and said, how can we make banks make more money? What they haven't done is added that piece of analysis to another piece of analysis, which is what is the effect of banking on the rest of the economy. And as we look at things more holistically and add things together, we get a completely different picture.
Well, if we don't act, we continue to live on the edge. We continue to drive at 100 miles an hour, and it works until it doesn't work. I believe it's the responsibility of sensible investors to speak up more. I think the big losers in the end is innocent public from a system that's very unhealthy. So the public then needs to demand a better system, and through the people who manage their money, to say that their money is being invested in all kinds of things in this system, and that to the extent that they invest in banks and are also clients of banks, they need this to be a better system, and so people within this system need to speak up.